Hey, what is up everyone, it's David here. In this video, Novonix gets included into ASX 300 and their share price went to the moon and some more. On top of that, Affirm, a buy now pay later company led by PayPal Mafia Max Levchin, have released a strong Q4 revenue results as well as provided really strong Q1 revenue for next fiscal year as well. And because of that, their share price literally almost doubled in a span of a little bit over 2 weeks. Most importantly, a lot of you have asked some really strong questions, so I want to take this video to address a lot of those. And yes, I am trying something new. So if you do have a question you want to ask me in the future, just let me know in the comment section below, or if you see a question that you really want answered, just make sure you like it so it goes all the way to the top so I can see it. As usual, if you do learn something new, it would mean the world to me if you could gently smash a like button somewhere around here. And if you really like what I'm doing, consider supporting the channel via Patreon and try out my Discord server where I talk a little bit more openly about things. And of course, no, this video is not financial advice or recommendation to do anything. So without further ado, let's go. So the first part of this video, I want to spend some time to answer the questions from how to make more money with little time. And the second part will be on Novonix and also Affirm. So feel free to jump to those sections if that's more relevant to you and then come back to this one. Now, one of the more common questions I get is, what are the numbers on the top of my thumbnails? Are these profits? What does that actually mean? The answer to that question is, I wish it was pure profits, but a lot of it is my own contribution. Now, the whole idea of starting this YouTube channel in the first place was to keep track of my personal finance journey. So I started this channel about a year and a half ago in the beginning of 2020. And at the time, my portfolio was worth 32,000 Australian dollars. And now I'm currently at approximately 184 to around 185,000 Australian dollars. So this is a really good time to do a portfolio update. For my stake account, it's currently worth 48,000 USD. So that's give or take approximately 66,000 Australian dollars. And around 10,000 of this will be considered as unrealized gains, so profits, if you will. If I haven't sold them, technically they're just not classified as profits, but I am up 26% on this account. Now, this will change on a day-to-day basis. That's not really that important. And a lot of you have asked for a dedicated video to explain the rationale behind each of the individual positions here. So I will dedicate a future video for that, but I am fairly certain for the people who have been following this channel for a little while that I have provided more than adequate reasoning for all of these individual positions. I think it's just scattered across different videos, so it's a bit hard to find. So I will dedicate a full video on that. Now for my CMC account, which is a blend of both Australian companies and US companies, I'll take some time to explain the passive investing side of my portfolio and more of the active investing side of my portfolio. So the first question that keeps coming up is, how come I went with VTS and not other broad index-based products? And the answer to that question is that VTS tracks the entire US market, whereas IVV and some of the other products tracks S&P 500. And if you look closely into the S&P 500, it's pretty concentrated in tech companies. So that's really up to you. And my personal preference is that I don't really care if I have to fill in a W8 bend form every 5 years or so. The whole point of this passive investing side of my portfolio is to have broad diversification. So VTS ticks all my boxes on that one. Now, the second most common question I get is, how come I went with Argo Investments but not VAS or Australian Financial Investment Company? And the answer to that question is, again, very simple. When I look at VAS portfolio at the time, it was very concentrated and still is very concentrated towards the big four banks. And if you dig into it a little bit more, and this is why you should do your own due diligence, in VAS, you have 8% in CBA, you have 4% in Westpac, almost 4% in NAB, and 3.6% in ANZ. And of course, around 2% in Macquarie as well. That was a little too much for my own liking. And it's a similar problem for AFIC as well. There was just a little bit too much banks for my liking, and this is one of the main reasons why I went with Argo. Now, Argo, on the other hand, is a little bit more spread out amongst the other industries, and this fits with my passive investing strategy a little bit better. That's why there's not really a right or wrong answer. It just really depends on what you prefer. And I really prefer to not be so concentrated in the big four banks. Now, if you look at the top 20 investments in Argo, this changes on a month-to-month basis. Macquarie's is only at 6% only because it has grown to 6%. It was actually lower before, but it's just Macquarie went on a really strong run. But besides that, CBA, ANZ, Westpac, and NAB are relatively even distribution amongst the four. So I just feel a lot more comfortable with Argo, and this is why I have that in my portfolio. And another question that keeps coming up is, how come I have WAM Research as part of my passive investing portfolio? And to tell you the truth, besides the large cap exposure that I'm going to get in Argo and also VTS, I would love to have some mid cap exposure as well. So WAM Research gives me that exposure. I'm happy with it. And yes, the management fees are a lot more expensive, but it fits with my passive investing strategy. So there isn't really a right or wrong answer to that. It's just, what do you prefer and what do you like? So that's the passive side of my portfolio, and it still makes out a pretty big chunk of my overall portfolio. So for my short-term portfolio, this is really a place for me to learn to combine fundamental analysis and also technical analysis. And I think the best way to learn is actually go try and do it and figure out a process that's repeatable enough. And that is one of the main reasons why the sizing of this side is so small. I've documented the reason why I have Redbubble and NRW holdings in this video right here, so feel free to check out that video after this one. So the two positions I want to spend a little bit more time talking about is CrowdStrike and Peloton. Now this is Gartner's Magic Quadrant on endpoint security as of May 2021. And you can see that the vertical axis is ability to execute and the horizontal axis is completeness of vision. And in both categories, Microsoft and CrowdStrike are the absolute leaders in that space. And I just want to add here that when it comes to cybersecurity, I won't look at smaller players because I believe that cybersecurity isn't something that you experiment with when it comes to those kind of things. So why bother looking at the smaller contenders when I know that there is a clear leader in the endpoint security game? One of the main reasons why I haven't built out my position in CrowdStrike is mostly because of valuation. Now what you see in front of you is a scatter plot of cloud companies with a line of best fit. Now the horizontal axis is revenue growth, vertical axis is revenue multiple. Basically, the way to understand this graph is that when it's above the dotted line, that's what you considered as overvalued. And when it's below the line is what you considered as undervalued. It doesn't necessarily mean that is true, and this is why you should do your own due diligence. But CrowdStrike at a given revenue growth level should be expecting a little bit of a lower multiple, but they did get rewarded with a higher multiple. So this is one of the main reasons why I haven't built out a position. And this is a screenshot taken from the Cloud of Judgment newsletter. So if you are interested in that, I will leave a link in the description box below. I'm not sponsored, but I read this pretty religiously around cloud software companies. And the thing that's really interesting to me when it comes to Peloton is not because of their recent announcement of going into their apparel business, but it's more because of the general sentiment divergence when it comes to Peloton being a work from home stock. I don't really agree that it's purely a work from home stock, mostly because I think even if the restriction gets lifted, not everyone will feel comfortable enough to go to the gym. And yes, you can just go out and run and have a bike and bike around and so on and so forth, but not everyone will want to do that. It just seems like everyone assumes that, hey, when the restriction gets lifted, everything will go back to normal, and I don't believe that to be the case. Okay, so let's talk about Novonix. Over the last couple of weeks, it has been on an absolute tear, and there are a multitude of reasons for this, but I think there is one that really stood out, and that's being included in the ASX 300, and the quarterly rebalance just recently happened. So if you open that document, you can see that in ASX 300, these companies were included. Now, why is this such a big deal? When a company gets included in ASX 300, what will happen is a lot of the passive investing funds, like for example, VAS, will need to buy these stocks and sell everything that was removed. So for example, Bob's, Harm, Jupiter Mines, and so on and so forth, these companies will need to be sold for any of the passive funds that are tracking ASX 300. And the passive funds that's tracking ASX 300 will have to add these to their portfolio. So Novonix was definitely one of them. More importantly, what's really interesting is that if you go to market index, go to popular pages, and then go to list of ASX companies, and then you want to search for Novonix, you can actually see that Novonix is actually, it's way past ASX 300. It's currently within the ASX 200. So if they can hold this position for a long enough period of time, it's very likely the passive funds will have to increase their position because Novonix have moved up in the position within the 300 companies. The 300 companies is based on weighting. Now remember, this is really important. Novonix is not trading based on fundamentals. The company is expected to essentially be at scale production, well, more scaled production in 2023. Right now, it's barely generating any revenue. So it's really important to note that when a company like Novonix rallies, and it rallies this hard, it's not really based on fundamentals, if you will. Well, at least not from what I'm seeing. So if it's not justified by fundamentals, the share price could stay at a certain level for a while until the fundamentals catch up, or the valuation would need to come back down to reflect the fundamentals. That's generally how the market would eventually play out. And also a surprising fact is that in Argo Investments, which is one of the ETF I owned, one of you have actually reminded me that they have owned Novonix since early 2019 or even earlier than that. So I actually indirectly own Novonix in Argo as well. So when it comes to Affirm, which is a buy now pay later company led by Max Levchin, who was part of the PayPal Mafia era, the first rally at this point right here was because of the Amazon partnership. And Amazon, obviously in the US, generates a huge amount of revenue. And being part of that would hugely benefit their gross merchandise volume growth. Now, the second rally came from a very strong Q4 revenue, and they've issued in the same earnings call that a strong Q1 revenue guidance. If you haven't had the time to take a look at what happened in the earnings call, I highly encourage you to take a look because sometimes these earnings calls are super helpful to understand the business. But on top of that, the partnership with Shopify from months and months ago is starting to yield fruit. And the Shop Pay, which is essentially the buy now pay later service partnering with Shopify, have brought Affirm thousands of merchants. And it's probably going to be the same thing with Amazon as well. Now, the good thing also is that Affirm was very reliant on Peloton's customers back in early 2020. But ever since then, partnership with the Shopify have diversified their customer base a lot more. And I think that analysts believe that with the Amazon partnership as well, it's going to diversify their customer base even more. But what I'm really not sure of is at 20 times forward sales, I don't really know whether that's what you call an attractive valuation. So from a valuation standpoint, you can see that Affirm's forward EV revenue, the mean is around 20 times. When I first started looking at Affirm, I was looking at it between 16 to around 14 times. And I never pulled the trigger on it because there was a lot more interesting opportunities, like for example, CrowdStrike, Snowflake, etc. As of currently, it's trading at 28 times, which is quite a bit above the historical average. So you really have to do your due diligence to understand whether this is actually overvalued or you believe there is a bigger opportunity. As it stands, I don't own any Affirm stock and I don't plan to. I think I have my hand relatively full by trying to understand CrowdStrike, Peloton, Snowflake, and some of the other companies as well. So as you can tell, this is a completely new day and I'm in fresh clothes and I'm recording an extra section to answer some of your questions from my previous video. And B Tran is asking, "Hi David, thanks for a great video. I was wondering, do you currently have a mortgage? And if so, how do you juggle FIRE with a mortgage?" Now, FIRE stands for Financial Independence and Retire Early. Now, retiring early is not as exciting to me as financial independence, but I won't talk too much about that. Yes, I do have a mortgage shared with my girlfriend. And the way that we juggle FIRE is, firstly, we are not over leveraged, so we understand how much we can borrow and what is, I guess, relatively safe with our income levels. Secondly, we live below our means, and that means we're not really lavish with the way that we spend. If anything, I have a spending problem when it comes to buying coffees or buying extra gear for these YouTube videos. So I do have to give a shout out to my girlfriend because she helps me keep in check a lot of my erratic spending behaviors that really needs to be kept in check. But most importantly, I think that most of us are pretty good at saving money, investing money, but we tend to neglect the generating income part of that equation. So this is one of the main reasons why I made the video on how to make more money with little time, mostly because I think it's really worthwhile to boost your income and work on your income potential for the future. Now, the second question, which is a longer question from Matt Baker, is that I noticed your career and side hustles are all quite similar, so your skill set would have crossover, making it easier for you. What about for someone who's in their career that pays well, but don't particularly have an interest for, but have interest in other areas completely different to their job, but not as much skill in those areas as compared to their job? Is it more beneficial to keep pursuing your career or learn something completely different and then leverage that into side hustles? I can't speak for everyone, I can only speak for myself. And this exact situation have happened to me in the past, and I didn't leave my job. I stayed in my job to generate an income, leverage that income to invest in my education, whether that's courses online or spending time with mentors, etc. And that have helped me learn a new skill. I get to practice it on free projects until I can charge for it or even move jobs into something that I actually want to do. And that's actually how I transitioned from doing something that I don't want to do into doing something like digital marketing, which is something that I actually want to do, and made that both into a career and also a side hustle as well. Of course, everyone's circumstances are very different. So if you disagree with me, let me know in the comment section below why. Or if you have other questions you'd like me to answer in the next video, also let me know in the comment section below. So thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.